Welcome to our commercial seminar. I am Jenny Ching, your 2021 Education Committee co-chair. Today's topic is Commercial Lending 101. A friendly reminder before we begin. All participants will be muted during the meeting. Please use the chat box for questions, and the speaker will answer your questions during the Q&A session. This meeting is being recorded and will be available on our West San Gabriel Valley Realtors YouTube channel. Now, I would like to introduce our speaker, Joseph Lam. Joseph is the founder of Azora Holdings and Loan Direct. He is also a leading real estate financer with more than 30 years of experience in real estate and finance. He oversaw 16 billion in real estate finance transactions and is currently active in real estate development across the US and Asia. Without further ado, let's welcome Joseph Lam.
Thank you so much for the opportunity to be here today with you all this afternoon. Thank you for the West San Gabriel Valley Realtors for the opportunity to speak at this event, at this virtual event. I think we did this last year, about almost a year ago, and hope to be able to do that live again. But right now, Zoom is what is in, right? So let me get started. And we'll make it quick, probably about 30 minutes. And then after that, we have the questions and answers session. So, all right, so a little bit of background about me. I've been in the lending business for about 31 years. Been doing both commercial and residential. Currently, I'm the CEO of Loan Direct. We have a sister company called Azora Capital that handles the commercial lending of that. Since I've started this career, we've financed over $17 billion in real estate finance. And majority of that we end up selling to Wall Street. So a lot of our loans are a little bit more flexible than your standard bank loans. In any commercial finance, it's very important to understand the asset type. So we'll go through each slide and we'll explain each slide and what they mean. Asset types is the beginning. Now most realtors or most agents call me and say, "Hey, I have a commercial building I'd like to finance." Well, commercial buildings, they have a variety of flavors, right? So just by the virtue of saying commercial doesn't mean anything to a lender. So you have to be very specific to what that is. The first four are the most common. We have the multifamily, or what is commonly referred to as apartments. So in commercial, anything that is 5 units and above is considered commercial. That's what we call that multifamily. Currently, multifamilies in our areas range anywhere from 5 units all the way to as large as 200-300 units, as you've seen some of the bigger projects being built. And it's getting quite popular in the LA and Orange County areas to build multifamilies. The next category is retail, which you're quite familiar with. It's your local retail stores, restaurants, shopping centers, and so forth. Retail is quite prevalent in the LA and Orange County area as well. And we'll explain what type of specific retails later on in this presentation. The next is industrial. Generally speaking, industrials are buildings where you see manufacturers, a lot of storage, warehouse. And you find these are more common in the less dense population area. For example, in LA, you see in Commerce, City of Commerce, you see a lot more than you see in downtown LA. Now, a lot of these buildings are moving out to the outer skirt, Pomona, Corona, etc. So generally speaking, industrial buildings are larger footprint, and they generally speaking require a larger structure, parking and so forth. Therefore, it's not very popular in the high density area. Offices, much like where you and I are sitting, there's a lot of offices where the cities are. And obviously, these are a specialty asset nowadays. We'll explain that shortly. Okay. So those are the 4 primary asset class. Now, outside of that, you can have all kinds of specialty use. And each building depends on what is in it. We actually classified separately than the 4 basic that we just gone through. We probably won't have enough time to go through all the asset class, but this will give you an idea of what these are. So if a building being used for one single purpose, that becomes that particular asset class. For example, the first one you see is the hotel. That's classified in the hospitality. So if there's any buildings that have been used as a hotel or short-term stay, we classify that as hospitality. Okay. The next one, you see senior housing. So senior housing is no different than your apartments, your multi-units, right? However, because it's classified for 55 and older, now that becomes senior housing and has some special restrictions or special financing terms that comes with it. Okay. Automotive. Automotive, again, is a specialty use. Gas station could be automotive, auto repairs, auto dealers, all of these are considered automotive. Now, if you're in a retail complex, and in that retail complex, you have an auto repair store, whether it's oil change and so forth, that retail complex may end up classified as the automotive financing because it depends on the size of that being used. Okay. There's a couple of things that's not listed on here. Cannabis. Cannabis is obviously legal in California. So if your retail building of 10,000 square feet is traditional retail, but if you put in a cannabis store, that becomes a cannabis specialty finance. So be very careful about the tenants that you put in because certain tenants require certain requirements to finance those. Example, any SBA loans today will not finance cannabis, even though cannabis is legal in California. So specialty use is very important and pay attention to that. There are multitudes of specialty use, and again, we'll take forever to list that here today, but we'll try to bring that in the question and answer later. Okay. All right, before you know the financing and what the banks are looking for, we need to know what the market trend is. And the market trend is very important to what a bank would lend or not lend. Right? So we get this out of the way. Obviously, the first thing first is COVID. And that's the reason we're all sitting on Zoom today instead of meeting in person. And that's a special effect in 2020. Obviously, still effect in 2021. And we feel that it's going to be another 3 or 4 years before the normalcy coming back. So the word normalcy, which is anything before 2020, likely won't come back until about 3 or 4 years later. So we forecast the COVID impact is going to last until 2025. Okay. So what are these? The first obvious is your lockdown. We are in California, particularly in Los Angeles County, is the tightest lockdown, and the other one is the opposite, is Manhattan, the two tightest lockdown cities in the country. And lockdown has the consequences. Obviously, we see that the ease of locking down and so forth, restaurants start to open outdoor, eventually it's going to open indoor. But what happened is during that year, a lot of business owners are unable to keep their doors open, and therefore has a lot of financial impact on the store itself, and then subsequently go to the impact of the landlord. And then ultimately, if the landlord suffer financial constraint, it's then to the lender. Now, none of this is going to be realized until maybe a year later, perhaps the end of 2021, because currently you have the eviction moratorium, you have the foreclosure moratorium, you have the forbearance, so forth. All of those going to come to an end. Now, they can extend it sometime, but cannot extend it indefinitely. I believe LA County is currently to September 2021. So you have that, a little bit of a window there for them to catch up and so forth. But the sad part is, to be quite honest with you, most of these owners are unable to make up when these moratorium will lift. So we forecast there'll be a lot of store closure, and perhaps there'll be some landlords that suffer and ultimately become either short sales or foreclosure sales. So 2020 is going to be quite interesting. We're kind of hunkered down and raise ourselves for the worst. Remote workers, this is extremely important. As you know, all of us are currently on Zoom, and many of us are working from home. And the effect of working at home, there's a couple of things that happen. You know, when you work at home, you know, kids are home, you're home, where in the day used to be maybe 1 or 2 family members. Now in the day, you might see 5 or 6 family members. That means that your demand for housing has changed, whether it's bigger or smaller, depends on your size, of course, but that changed where you want to live. Also, your demand to be near work is no longer important, so you may end up driving a little bit further, and therefore you would seek areas that may not be immediate to your work. And last but not least, many companies, including ours, have been working from home. The employees have been just as efficient with working from home as they are here. And if a company can save $500 to $1,000 a month per employee, what is the reason for the company to bring these employees back? Likely not. So if Amazon can get 10,000 employees work from home, they likely would not bring those 10,000 employees back. And that has an impact on commercial real estate. About a year and a half ago, I did a speech on commercial real estate, and there was a term called urbanization, actually about close to 2 years ago. At that time, you see a lot of areas that built in, where they have retail on the bottom, apartments on the top. People like to gravitate towards the center of town. They can go shop in the same place that they live, they can work in the same places they live. Now, unfortunately, with the COVID, it seems like it reversed 180 degrees. People are now saying, hey, I don't need to be in the town anymore. I don't need to drive. So I'm going to move a little bit further. Example, in LA, I'll go to Corona, I go to Pomona, where I can get a single family house for the same as my little tiny condo. And I don't have to fight all that traffic. So it seems like that's the trend. People are either moving away from the immediate areas they live in, or they even moving away from the state that they live in. We see a lot of migration from Bay Area, San Francisco, towards the Sacramento Valley. We see a lot of migration from Orange and LA to the Inland Empire. And this is a trend that's quite popular, and I don't believe that's going to stop anytime soon. An effect on e-commerce, I think without a doubt, all of us have spent quite a bit of money online in the past year and continue to do so because it's making it very convenient. So I don't have to go shop. I don't have to get in line. Most stores, even if they open today, you still have to get in line because it's limitation on how many people can go in. Masks, things of that nature, whether you like masks or not. Some people say, hey, I'll just shop them home. It makes it a lot easier. And again, you see that trend in 2020 is 374 billion. And again, the trend is continue upward, and we don't see that slowing down anytime soon. So this has a huge impact on retail. What kind of retail? Majority of these are going to go into your big box retail. A lot of stores are obviously, we see Sears run out of business. We see Macy's struggling. So a lot of big box stores are going to be changing whether they're going to change and adapt online or just simply go out of business. So this is going to be a huge impact on commercial real estate. The one impact that you may or may not be aware is the interest rate environment is trending up. I think we all see around us that things are getting expensive, right? Gas gone up. Many things have gone up, particularly interest rate. If you look at the blue line that I've highlighted with the with the red arrow, for the first time for a while, the 30-year interest rate has gone above 3%. Now, we're talking about a conforming rate, 30-year fixed, nothing fancy. What this does is has a huge impact on the current housing. If your buyer were approved for an $800,000 loan at 2.5%, if the rate simply go up a quarter to 2.75, that $800,000 approval would drop likely 10%. So they no longer have the same buying power. Well, since we're talking about commercial, what are we referring to the residential for? What does have quite a bit of impact? It will slow down in the purchasing power. That means that they're not going to be able to move out their apartments, perhaps. So a lot of dynamics going to change. If there's slowness, if there's a slow in residential, it will carry over to the commercial side. Okay. All right, now we get into the finance section. What do you need to know to be able to speak to a particular banker regarding a commercial finance? We got a couple of terms that these are not all the terms, of course, but these are the certainly main terms that you need to remember and perhaps understand. Number one, anchor tenant. If you have a major shopping center, generally speaking, larger than 20,000 square feet, we like to see you have an anchor tenant. These are either referred to anchor or credit tenant. So usually you see supermarkets, Albertson, Ralph's, 99 Ranch. These are considered anchor tenants. and they offer credit that's far beyond what the other tenants can be. Their financials quite strong, and this will allow you to call themselves either an anchor or credit tenant. Okay. Number two, if the only term that you're going to learn today, I would rather for you to learn number two, debt service coverage ratio. In commercial, we rely on the income stream from the building more so than we rely on your personal income stream. So if you make $1 million, but your building does not make any income, it will make it a substandard finance. So again, the building income is extremely important. So the building able to service its own debts or not, it depends on the DSCR factor. Okay, most banks would prefer to see a 1.35 DSCR, and I will show you how to calculate that shortly. And we'll have a form for you to use down the line that you can use to calculate yourself, or we can help you with that. Environmental. Most commercial buildings, they're afraid of contamination. Restaurant can have oil leak into the soil. Automotive can have oil leak in soil. Dry cleaner. So a lot of factors can contaminate the soil. Once you contaminate it, it costs a lot to remedy it. The phase one is the initial review to see whether you need additional work to determine if you have contamination. Hopefully, most cases of phase one will clear. But if they come in to say, hey, phase one looks good, but we think that this restaurant had a tank that's been there for 30 years. Well, you got to go to the phase two. The phase two is the physical part of it, which they have to dig to the ground to determine whether that tank is still good or not, right? If that tank's not good, then you have potential contamination. So understand that if you get into commercial space, environmental is extremely important. Lenders will not lend unless there's a clear environmental study for phase one or phase two. Okay. Number four, multi-tenants. Multi-tenants means that your building has more than one tenant. Lenders don't like to go in with one tenant in a 20,000 square feet building, because if that tenant goes out of business, guess what? You don't get rent. So we prefer multi-tenants. Multi-tenants is currently looking at as anything having 5 or more. Take that same example, 20,000 square feet, we rather see 5 or more tenants go into that building. And I think if you look at typical retail stores in, say, downtown LA, downtown Orange County, you will find that average tenants to go in there is maybe 1,000 to 2 square feet. You're not going to see your tenants that are taking 5 or 10,000. So you're certainly safe with that. The single tenant, generally speaking, standalone restaurant. So that could be a little bit more risky for the lender. So it'll be harder to get financed. So single tenants is a little bit harder to get financed. Now, unless they're credit tenant, of course, right? If they're a Fortune 500 company and they have credit to withstand the debt, then it should be okay, right? Number 5 is the metro statistical area, which is loosely defined as population density. If you're in LA, Orange County, San Francisco, you should have no problem. We have the highest density there. Most lenders prefer to lend here because the more people, the better for commercial property. When you start to go to outer area, and let's take an example, your client's buying something in Victorville. Obviously, the population density is very low, and therefore the term is going to get different. The same building in LA might get financed at 75% loan to value or 25% down. If you move that building to Victorville, we might say that we'll finance to 65% loan to value, which means you got to put an additional 10% because the risk is higher in a lower density population. Okay. Number 6, operating statement. Operating statement is very similar to a business. If you run a business, I'm sure you understand what a profit and loss is. So operating statement is pretty much the building profit and loss. You bring in how much rent, you pay tax, you pay insurance, you pay management fee, take in vacancy factor, take in any repairs allocation. That would give you your net operating income. which would be very important, and that is, okay, number 7. In fact, my apologies for not putting on the net operating income. So I missed the one term that's very important, NOI, net operating income. So obviously operating statement has the gross income less your expenses, which we just described in tax, insurance, maintenance, things of that nature, and it gives you a net. That net is called net operating income. Okay. Number 7, personal financial statement. Very important to maintain a personal financial statement on the if you are a commercial landlord, because either quarterly or annually, your lender's going to want to see your personal financial statement. Or if you're shopping for one, you have to have a fresh one so that when you do secure that location that you like, you have that ready to go instead of waiting for it. Again, most professional landlords, they do have this maintained, and that's very important. Okay. Phase 1 and phase 2 already covered, so we skip that. Number 10 is rent roll. Very important we keep an accurate list of rent roll. And on the rent roll, not just the rent that is concerned, we want to know when you sign the lease, when the lease can expire, because if you have leases that are expiring next month, your income may change downward or upward, right? So we obviously need to know that. So the rent roll is quite important to maintain accurately. Okay. All right. So this is what a rent roll looks like. Again, there's multiple format of it. We do have this format. This is free to anyone who requested, or Pauline, you like, I can certainly send one and you can distribute it out as well. It's very easy to use, and you can offer this to your customers and save them from trying to make their own form. Okay, very important. This is the operating statement. Again, we have this form for use. It's quite simple to use. We make it so that any person can fill this out. Quite simple. Your gross income. We take in vacancy factor. Right now, lenders taking anywhere from 5 to 10% vacancy factor. So even if you're 100% occupied today, you still must use a factor of minimum 5%, because obviously we know that throughout the years you will have some vacancy. 5 is low, and 10 is conservative. So it depends on your situation. You can use 5 or 10. Real estate taxes, insurance, management fee. Now, management fee is very interesting. Even if you don't use a manager and then you manage yourself, we still need for you to put it in there, because the fact is that we want to see that you earn your own management fee, because that's what the cost is all about, right? And right now in California, we like to see a 5% management fee. We'll take a census on what everyone thinks management fees today is, but I think 5% is what the market is for California. In some certain areas, it's a little bit higher. Replacement reserve depends on how old, how new your building is. You may increase or decrease that number. Okay, and others. So quite simple with this form. And then you have the net operating income. Okay, right now, if you don't have this form prepared, for whatever reason, this form's not ready or is incorrect, lenders, generally speaking, use 40% factor. So in other words, if you bring in $100,000 in rent per year, we then take 40% or $40,000. That would be your expenses. Now, when your actual expense come back, it might be lower or higher, but generally speaking, without this form, we just simply take the 40% to calculate what the NOI is. All right, so this is the debt service coverage ratio. The formula to the left of it is basically the NOI, net operating income, divided by the debt service. The debt service is simply your mortgage payment. Okay, most commercial loans do take interest-only payment, so you can take the interest-only payment. The net operating income divided by the interest-only payment, which comes to the factor. Give you an example. If your net operating income is $10,000 per month, and your debt service per month is 8,000. I'm doing the math right here on my calculator here. You take 10,000 divided by 8. That's 1.25. So 1.25 is the DSCR. Okay. To the right of it, you see an example, and the example to the right show you a 1.176 DSCR. All right. We spoke about environmental, but we want to expand that a little bit here. So the environmental has the two phases. Phase one is basically a determination of the potential risk on the property. If they determine that there are potential risks, then they'll request a phase two. The phase two is quite expensive. In most cases, a phase one in LA, Orange County, depends on the size, of course, but we can get done around $2,000 to $3,000 for the phase one. Phase two depends on what type of remedy it is. It could be anywhere from $30,000 to $40,000 to $50,000 if they have to dig up a tank underneath, say, a two-story building, right? So it can get quite expensive. Very hard to determine what the actual cost is. Depends on what kind of problem that is, but do expect quite a few expenses come along with that. So anytime I receive a phase one, I just pray to God that it is clear. So. All right, what is the typical down payment for a commercial property? Typically, banks want to see a 25% down. Now, you can potentially go to 20% down, but it is a lot harder requirement at 20% than 25%. If you are buying a commercial building for your own use, that means that you buy a restaurant and you run the restaurant. The SBA does allow a 15% down, so a little bit lower than your standard conventional financing. Now, SBA does require that you occupy and operate that business. That's the only difference. Okay. With the current market today, institution, generally speaking, a little bit harder. Institution, local banks, and I'm not even talking about the big 5 banks. We're talking about Bank of the West and so forth. Smaller banks that are a bit more lenient. They like to see full doc only, means you got to send in your 2 years tax returns. They want to make sure that you have sufficient income to cover your household payments and all of that. And then they want a DSCR of 1.25. Now, caveat, most banks are now, because of COVID, now requiring higher debt service now. They want 1.3 to 1.35. So it depends on banks that you can find, but standardized is 1.25 minimum, okay? Rate range is 4% to 5%. So your question is, why is it such a big spread? It depends on the property type. For example, multifamily is more stable because obviously apartments are easier to maintain. Incomes are quite stable. It can get better rate. In fact, we did a couple of multifamilies at 3.89. Okay, so depends on the property. Depends on the how nice it is, where it is, and so forth. It can change the interest rate that the customer get. Typically, for the institution type of loan, you could see a 1% origination fee. So a $2 million loan means $20,000 in the origination fee. Okay. Now, very simple. You either qualify for institution or you don't. So if you don't qualify for institution, you go to private. And I use the word private. This is loosely named. It's non-institution. Now, banks have to follow certain banks guidelines. There are banking institutions that are not depository. Hedge fund, life insurance company, could be private capital. These are all institutions, but they're non-bank institutions, and I classify them as private or non-banking institution. Those are a little bit more lenient. They would take reduced docs or stated income. They may take a lower debt service ratio. Obviously, because of higher risk involved, their rates are a little bit higher. 6 to 9% depends on what type of loans you're doing, and depends on how nice your property is and what type of property you're doing. Again, multifamily gets better rates than you would get an industrial building, right? Believe it or not, the private side has improved in rate. We did a couple of apartments with stated income apartments with rates in the low 5% range. So rates has improved on the private side because they want to compete with banks. Okay, their fees a little bit higher, from 2% to 5%. Typically, I see that most clients come into the 6% rate and 2% fee. When you get to the 9% and 5% fee, that's generally speaking hard money. Why do you need hard money? Your building is half vacant. That would be one reason that you need hard money, because it does not debt service. Your building is needing rehab, it's not up to standard. That would always require hard money because no institution can lend on a building that's not ready to occupy. Your building may be mixed use or grandfathered in. So it might be a mixed use residential, but right now calling commercial. Well, it's not zone commercial. I'm sorry, the building is, the lot is zone commercial, but your building is still residential. That's a grandfather use, and most institution lenders would not touch that. So you got to go hard money. So there's quite a few reasons why commercial require private lending to have that happen. And again, could be cannabis. You know, beautiful building, but you have cannabis in there when nobody's going to touch. Now you got to go hard money, right? So quite a few reasons to go private or hard money. All right. Now we want to point out a couple of creative financing solutions. Well, traditionally, if you well qualified, great credit, if you have 2 years tax returns with lots of income, if your building is beautiful and fully debt service, you can always go to Chase, Wells Fargo, and so forth, and they'll give you excellent term. 9 out of 10 times that doesn't happen. So what did you do? We have alternative programs such as stated income, means we do not require for you to submit a tax return. We have a no doc program, which means we don't even care, even if you work or not, or employee, we simply use the cash flow of the property to qualify you. Okay. We discuss about non-stabilized property. Non-stabilized properties are properties that are still half vacant or more. Okay. These properties do not debt service, and therefore they call them non-stabilized property. Okay. The last categories, the condition of the property, whether it's terribly run down, it needs rehab, or it needs construction, that would be something that would consider that you would need some creative financing, right? Now, the beauty about this is a lot of buildings in where we live, Southern California, are older, and that means that there's a lot of upside opportunity. You might see a cap rate of 3% today. But because the property is so old, you may be able to come in and do tenant improvements in there and bring it up to a 6% cap rate. So the rehab, the construction, or the non-stabilized properties is actually an excellent opportunity for your clients. So don't overlook that. All right. So now that we have the basic, let's look at the market forecast, where things are going, which market is hot, what lenders think about, because at the end of the day, lenders are always thinking about something, right? So we need to find out what they're thinking, what's going on. Right now, most institution favors a couple of asset class. We talked about multifamilies, which is the apartments. And generally speaking, in the LA Basin and Orange County, most apartments are 40 to 50 years old. There's a lot of upside potential with those for the rehab and so forth. We see quite a bit of success from our investors that are doing this. We have the templates for you to do this. If you ever have clients that need to do this, we have the calculation method, how to calculate to get the upside. So multifamily strong. Senior housing extremely strong. Every day there's 10,000 seniors are retiring at age 65. So population on the getting old. The forecast for the next 10 years for senior is going to be 36 million people are going to be retiring in the next 10 years. So quite a few demands for senior housing. Okay. Smaller retail, 500 square feet, 700 square feet, 1,000 square feet are still popular. The larger big box retail, again, we spoke about Sears, Macy, those are going to get a little bit less demand, right? Because people simply just don't want to gravitate towards those anymore. Okay. The weak demand, office building, obviously, right now there's high vacancy in office buildings, particularly in the high density cities like LA, San Francisco. Simply, a lot of people are working from home. A lot of companies are continue to do that. So in the downtown LA, if you drive around there, I'm sure you can see that it's quite vacant during the day. And that's now become the normalcy of what we're going to see in the future. We talk about big box store, malls, same thing. You're going to see people shy away from malls, and that trend would likely to continue. We talked about hospitality. We feel that the travel industries will take at least 3 to 4 years to come back to 75% of pre-COVID. So our anticipation is from now to 2025 is what they'll take to get back to 75% of pre-COVID. Okay, so we got a few years of weak in the hospitality. There are a few things that I couldn't put on here because we simply don't have time. Restaurants right now is weak. Most lenders shy away from restaurant unless you're a name brand. So anytime you send me a building, 20,000 square feet building with a 5,000 square feet restaurant, we'll look twice. We'll think twice before we look at that deal. So restaurants are weaker right now. For the obvious reason, we know that they suffer. We know that it should take a long time for them to recuperate. And so therefore, financials, everything, right? The commercial, you got to make sure that the tenant's strong, the landlord's strong. So that's going to be the key. Speaking of weak demands, if you have a building now or apartments, we also look back at your past year to see how many tenants are behind, what ratios are behind. So that determines the weak demand for your property, right? If your property is 90% paid up to date, you're in a pretty strong demand market because that market maybe has a wealthier clientele or whatever. We don't judge your clientele, but we judge your books. So that's the key. Lenders just simply look at numbers. They don't look at anything else. So collection of rents also determines the viability of your building. Okay. That is a summary of today's presentation. I have my contact information on the screen here. If you'd like additional information or any question thereafter, I do prefer an email versus a phone call, or text is okay. I do get quite a bit of phone calls, so I may not return the call in a timely manner. And I'm also on LinkedIn and Facebook under Joseph Lam. So love to connect with everyone that's on the call today. So I'm ready for questions and answers.
Joe, that was a very informative seminar you have conducted. I enjoyed quite a bit, and listing all the different asset class and how you look at DSCR ratio. I think it's going to give our member a little bit more insight on how commercial financing goes forward. And the thing I did not expect is that you share how the COVID has influenced the market. So that was very interesting in looking at future trend. And it's a little bit depressing that to hear that it might take 3 to 5 years before we can resume to some sort of normalcy.
Well, with real estate, we always look for opportunities. So with any downside of things, we have to look at what the upside is. So example, with the hospitality, smaller motels rather, suffer the most because obviously people are not traveling as much and they don't have the financial to withhold. We've been seeing clients that are converting those into apartments. So we've seen some opportunities and upside in that situation. In larger downtown areas, we've seen this happen in Seattle. We've seen this happen in parts of Dallas. They'll take the larger hotels and do convert them into condominiums. So there are opportunities certainly to do that. Office buildings is also a candidate for a conversion of some sort. And so therefore, I believe that investors that has the know-how, that has the finances today, has a tremendous upside.
Interesting, you mentioned that the workers now are working remotely at home, doing telecommuting, and there's less demand for office space. The other thing I can see at the hospitality industry, how do we convert an office space into usable space?
There's a lot of particularly in the downtown areas, you can use the office space into loft style condos. We've seen a couple of conversion. We've seen quite a few conversion, as a matter of fact. Austin, it's all over the country. We've seen it in Austin. We've seen them in downtown Orange County. We see them in LA, San Francisco. You can convert them to loft style condos. Now, what we've seen better use of buildings is actually apply a lot from Asia. If you travel Asia as of late, Asia has has been very tactful in using all the spaces they have because they're tighter space, right? Hong Kong, so forth, they're very tight. So they usually divide that building to multi-use. Rather than strictly office building, they may have 2 or 3 floors as retail, 2 or 3 floors as office building, and then 2 or 3 floors as condos and so forth. So using multi-use like that allows you to be able to be more effective on the building. And again, we believe that U.S. will start to look like that in the very near future. In fact, we're a couple of our investor groups is doing a lot of that.
Good thinking. I'm going to go into the Q&A, Joe, if I may.
Please.
Okay, that's a question from Joanna Lane. And a landlord is looking for some sort of refinancing. Currently, the landlord owns a standalone property with a franchise fast food. She didn't name which one. And will this person be able to qualify for an SBA loan, and what are the terms and conditions?
Typically, if they are owner operator, then they can qualify for SBA loan. Yes.
Oh, okay.
And the terms and conditions, generally speaking, right now, SBA loans is usually prime plus something. And so currently prime plus 1.5 is what the market rate is for SBA loan.
Okay. And I have another question for Mario Manzanilla. And he was asking, how do you finance smaller entities such as commercial, other commercial and gas stations, probably smaller commercial buildings? And he asked a question on restaurant. And you mentioned now restaurant, and we experienced it too. Now a lot of restaurants are closed, so we can't go and eat. And lenders are a little bit skeptical in lending to this particular niche. So for him to open a restaurant, how much does the bank or private lenders require on a down payment percentage-wise?
So let's take restaurant for example. Restaurant today, most institution would not lend, so that's out of the question.
Oh, so they won't even lend. If I want to open a restaurant tomorrow, they won't even rent.
They won't even look at it right now.
Okay.
So you have to go institution. Apologize. You have to go private in that case. And most private lenders also feel the risk of restaurants, so they want to see a 50% down. So typical restaurant standalone building $1 million, you have to put in $500,000 for someone to lend. If it's very nice, they might go up to 60% loan to value or 40%.
Going back to Joanna's question, that the owner is renting to a tenant who was a franchise food, and then they want to refinance it through SBA. Is that okay?
If the owner is renting that property, then he does not qualify for SBA because SBA requires that he occupies. Yeah.
So the business can ask for an SBA loan. The owner
Correct.
of the building.
Yeah. You must own the business that occupy that building.
Okay, got it. Hopefully, Joanna, that answered your question. How about for a smaller commercial building? Going back to Mario Manzanilla's question.
Right now, tech restaurant away, assuming that it's still a nice commercial building, most institutions classify any loans under $1 million as small balance commercial. They will not touch that. And that means that you have to go non-institution. And again, that would be what's available today. And we can lend on those as high as 75% of the value. Again, assuming that it's a nice building that is currently leasing out and so forth.
So you're still looking for a 25% down payment?
That is correct. Unless you are going SBA, which means you personally have to run the business that goes in that building.
I don't know if there's any more question from the audience. If some of you still have questions, please type it on the chat box and I will try to relate that to the speaker. I have some questions, Joe.
Sure.
I'm a builder contractor. Do you guys finance new construction loans? I've got people who ask me as developers and they don't have sufficient funds to do a project and they're talking to me. So I don't know where to go.
We do finance construction. However, after COVID, many lenders have been burned on construction because obviously during COVID, they couldn't finish. And so therefore, many customers have exceeded their term. So lenders are now holding on to a lot of money that is probably not been finished. Construction lending is still available, but it's open to only seasoned builders such as yourself. Anyone who has not been doing it before, such as your customer, perhaps may not be able to do it. So in this case, the only way that potentially you can get it done would be your customer coming in partnership with you because you have the experience to make it work.
Interesting. So I assume half the list.
Yeah, you would assume some risk. Yeah.
Yeah, I'll assume some risk. From Max, and he wants to. The buyer wants to buy 2 units. That area is zoned for commercial. Can we get a residential loan since it's less than 4 units?
Anything now. I would imagine is that residential question? Is it 2 units residential?
Yeah, 2-unit residential zoned as commercial. So yeah, what kind of loan should he get? I think that would consider
residential nature, and we do finance those. Again, with those we have either the full doc or stated income. If the buyer's unable to provide any documentation, we do have a stated income for the buyer. So that's actually residential, but we can use the cash flow method to qualify them.
Okay, yeah, it's a small size unit. So hopefully, Max, that will answer your question. I don't have any more questions. Hold on. Let me read this from Dan Lee. Just read what he has. Commercial property has been paid off. The tenants always pay the property on time. So now the landlord want to refinance or cash out. Is that possible? And then how is the interest rate now?
That is very simple to do. First of all, again, cash out, simple to do. The interest rate depends on a couple of things, how much they want to get out. 50% loan to value is different than a 60% loan to value. FICO score.
Less now.
FICO score can
the LTV is a little bit less than before.
Yeah, so I think, again, that sounds like a simple deal, and I think we can get that done in around the 5% range, depends on the property type.
Do they need a personal guarantee, somebody to guarantee on that loan?
We can do non-recourse loan, means there's no personal guarantee.
Okay.
Yeah.
All right.
Many loans can be done non-recourse.
Okay, then hopefully that answers your question. Oh, Bernadette asked a question on construction loans interest rate. That's kind of up my alley. So how much does it cost now, Joe?
Construction loans are expensive because they're shorter term loans, and they range anywhere from 8 to 9%.
Is it hard money?
There's no traditional loans out there, so yes, you have to go non-traditional loans. So
okay.
Yeah, banks are not doing construction loan now, so you have to go to non-banks for that. So I guess the answer to you is it is hard money.
Okay. We have a definition question, Jenny Chiu, and she doesn't understand the difference between recourse and non-recourse. Maybe you can define those terms a little bit for someone who is new at this.
A non-recourse means that a lender would just simply take back the property without suing you for the difference.
Okay. And Mindy has a question on SBA loan. How long does it take to get an SBA loan process? 45 to 60 days or longer?
Typically, SBA loan can be done in 60 days, typically. Now, the sad part is that right now with the second PPP loans, most of your lenders are busy with the PP loans because that's the easiest loan for them to close and make money. So they'll put your traditional SBA loans aside. So I would say that today's environment with the PPP, I would say expect anywhere from 60 to 90 days to get it done.
Okay. Uh, can I ask another question, Joe?
Absolutely.
I have a customer. It's a potential project. The old tenant move out, and then he has a new tenant coming in, and the new tenant wants to restructure that whole office. It was maybe 10 offices, and now the new tenant, which is import-export shoe manufacturer and with some retail, doing wholesale work in the city industry. And they want to do a lot of remodeling and adding new office. The owner doesn't have the money to do the TI. So he was asking me, Mr. Lee, how can I get the money to do this type of work? I'm looking at maybe $300,000 or $400,000. So how do you structure the lending
Typically,
for him to do the
uh,
tenant improvement?
typically we can do a second loan for the owner, depends on how much his first loan is, and give that money for the TI. If the first loan is not an attractive interest rate, he may want to refinance it entirely and get the additional cash out. So it would be depends on what his term of the first loan now.
Okay. Can I ask a question on top of that too? Let's say if it costs 300,000, I make 300,000 to do the TI. Can I pass some of that cost back to the new tenant who is renting the place? Is there a formula that I spend that much money on fixing the place for you, so my rent will be some dollar amount so I can recoup some of my construction costs? Do you have a formula like that? And he was asking me this question.
Yeah, typically, if it's highly specialized TI, meaning that you know that it's only for one tenant, and if the tenant moves out, you cannot use that again. You would prorate that entire amount to the tenant's rent.
Oh, really?
Yeah, if it's a highly specialty use and nobody's going to come in and take it again, then it's no use for you, right?
Ah, okay. All right. Yeah, because I also dealt with an industrial area warehouse that they were manufacturing French fries for McDonald's, giant, oh God, probably 10 acres, no, maybe 3 or 4 acres worth of land, very specialized equipment. I went in and take a look at it, and they want to convert into something else. They were asking me, how much does it cost? I said, I have no idea. Because it was so specialized, and to tear all this stuff out, you need a lot of money, and I don't know where to get the financing. So in that case, you would pass the cost of reconstruction back to a tenant on the future, maybe 10 or 15-year lease. Am I right?
Yeah, you would amortize that out to the length of the lease.
Okay. I have another question for Max. Let me see what he said. It's a single family mobile home on a 10-acre land. Okay, I don't know how that works. Can you do a purchase loan? So it looks like there's a mobile home on a big piece of land, and they want to buy it. What's the term and rate?
So it's an interesting question, but I think we can learn from this. One is mobile homes are hard to finance now. However, in this case, really the values in the land, because let's say that house is being asked at $400,000, likely the land value is already 380, and mobile homes probably worth 20, right? So the lenders will look at that as a land loan, not a mobile home loan, or not even a home loan, because the mobile home doesn't worth anything. So we can certainly finance something like that, but substantial down payments required, because we look at it as land means more risk involved for the lender. We've done a couple at 50% level, and have, again, we've done these outer skirt of LA counties and so forth, and we see a lot of trend in the people are buying larger acreage, and they have very small homes on there. So it's possible, but I do need to see the particular address to give you a little more defined term.
I guess that's it for now. I don't have any more question coming in.
No problem.
So I'll thank you for your time, Joe. And it was very informative, and thanks for answering our audience question. I'll pass the seminar now back to
Thank you so
Pauline.
much.
Thank you very much.
Thank you. Thank you. I want to thank Mr. Lee and Joe for this wonderful section. If you have any further questions regarding the commercial loan or other idea you want to exchange with Joe Lam, please email him jlam@loandirect.us. On behalf of Western Gateway Valley Realtors, we would like to thank Mr. Joe Lam from Loan Direct Azura Capital for your informative presentation today. And Joe, remember where we met? We met in Hanoi, right? In 2019 International Real Estate Conference. What a great experience. We met there and we had a lot of fun time there. We hope to see you in person soon in Western Gateway Valley Realtors, and we go travel together. Okay, and a reminder for next class will be March 16th, Tuesday, 11 o'clock. We'll welcome our Nancy Chen, lawyer's title, will give us a presentation about everything you want to know regarding lasting description. This is very important when we do the transaction. Please register all classes at wsgvar.com. Choose the education and education schedule. You can register all the classes and come together to learn together. Thank you again, Joe, Jenny, Mr. Lee, Fang, and all of you attend today's class. We will see you next Tuesday, 11 o'clock.
Thank you.
Bye-bye, Joe, and see you
Bye.
soon.